Hi, Fiona. Thanks for joining me again. Fantastic to have you here with us. Really pivotal time for markets and in particular for the US. So I'm very interested to hear what you're thinking in terms of the US market and the outlook, and to hear a little bit more about how JP Morgan American Investment Trust is positioned. So welcome.
Oh, thanks, Mark, for having me. It's always a pleasure.
Looking back on this year so far, sort of 8 months in, and it's been another cracking year for US equities, hasn't it? Last year was very strong. This year's been very strong again. Are you surprised by how buoyant the market has been? Back at the start of the year, were you expecting such a good performance after such a strong year in 2023?
It's interesting. This month, I celebrate 27 years at JP Morgan in the US equities team. And every year always brings a surprise. There's always something that happens there. I think when we look at this year and last year, we can't just look at them in isolation. We really have to paint that picture, really post-COVID world, right? When we had such great earnings from companies, really you had 5 years of earnings over 5 quarters, right? Particularly for growth stocks, because we all needed Zoom, Teams, ways to connect, work remotely. And then we had a lot of these companies go through an earnings recession in 2022. So one, I think the key is we haven't had an economic recession. Our forecasts right now don't suggest we're going to have an economic recession, but we've had a rolling earnings recession. And it started in tech and tech enabled in 2022. And those were the companies that made the cuts first in jobs and capex. And then you saw their earnings rebound in 2023 when the rest of the market had their earnings recession. So no wonder they did so well in 2023. They were setting themselves up. I think what we'd expect from this market is one, a little bit of volatility. It's been absent until about August. About 4 times a year, the S&P declines 5%. We haven't seen that typical volatility. The second part is, the economy is slowing. It's not falling off a cliff. It is slowing, and the market needs to adjust. So one, to your question, are we surprised by the strength of the market? Yeah, a market that's up double digits, is always impressive. But again, thinking about with a little bit probably more volatility to come that we've seen, a little bit more angst. But again, a market that should continue to deliver, because when we look at the earnings growth, it's still double-digit earnings growth for this year, for next year, looking forward as well. So when we put that into the whole picture, I suppose the one surprise is not so much the market return, but the absence of volatility, which we'd expect to probably normalize from here, if that helps.
Yeah, and I guess if you look back at last year and this year, a lot of that strength has come from the Magnificent Seven, the AI stocks, or parts of the market that are exposed to that theme. And it's been an amazing run, hasn't it? With the Magnificent Seven more than doubling, and the rest of the market up reasonably well, but certainly nothing in comparison. So when you look at that concentrated group, the AI exposures, the Magnificent Seven, the tech heavyweights. Do you think that performance has been justified? And how are you positioned when it comes to that part of the market at this point?
Yeah, I think Magnificent Seven is a fantastic name, isn't it? And we love to give a cohort of stocks a fantastic name. We had the FANGs, and so, over time, you tend to have these periods where a group of stocks do very, very well. I think one, AI is a huge game changer. It's a wave of technology similar to how we've moved from fax machines to email, right? It just increases productivity, and there's so many use cases. In fact, JP Morgan is currently working on 400 use cases for AI. So companies make these investments because it increases productivity. And that in turn increases your margins, increases your profits. And we've seen US companies have their margins increase for well over a decade since the tech boom period. I suppose we're living in that golden era of what the tech boom period originally promised us, right? And tech is everywhere today. And so there's lots of use cases for AI. I think what we have to separate out within AI is the companies that are actually earning today because of AI, the Microsoft, the Nvidias of the world, a lot of the semiconductor companies, and the companies that aren't, but are riding on that wind, right? In terms of the tales of those AI, the promises, the dreams, they may never bring to the table. So I think one, you have to be very selective in where you're going. You can't just buy the overall theme. You really have to understand the dynamics, what's going to drive earnings, and see those companies in the marketplace. And when we look at those type of companies, those big hyperscalers, they're going to spend 200 billion on capex this year. Right? That's the Oracles, right? That's the Metas, that's the Microsoft of the world. That's up
Wow.
10 times from what they
Mm.
spent 10 years ago. Right. So it's big money because it is expensive. But if it comes with productivity gains, companies are happy to invest. So one, we do like it, but we're very selective. We do have NVIDIA in the portfolio. It's about benchmark weight. We really, really like NVIDIA long term, but we're also cognizant of the risk. This is a stock that's rallied significantly. It's delivered huge earnings, right? 150% nearly in the last quarter. They've really estimates have come in above expectations. And so when we're looking at these companies, we have to be cognizant of the risk. It's a stock that's rallied significantly. It's more expensive today. It still looks reasonable based on future earnings growth, but it's a darling of the market. And one hint of a word that doesn't work well or something amiss, right? We're seeing that a little bit with their semiconductor, their new chip. It's not so much about it being destroyed in terms of future demand, probably just a little bit delayed when it comes to market. And that creates volatility in a stock. So managing that risk is really important. So we're about benchmark weight NVIDIA right now. Could be opportunities to add to it again, or maybe it's something we have to trim. It depends on where the stock goes from here. I mean, we still consistently like Meta. We're overweight Meta. We think that's a stock that really plays very, very well into AI and what they're doing. And we can see it. Not in Europe yet, but if I was in LATAM recently and WhatsApp, they've got AI embedded within it in terms of assisting you, doing searches. You don't need to think about that additional app to look for things. And so again, that increases more and more use cases in terms of people wanting to use their technology. So they've kind of stolen a little bit of the AI story from where you'd expect a Google to be, right? So Alphabet has been left a little bit behind, and you have to be very, very careful there. So, for us, it's about being selective. So within AI, we have Meta, we have NVIDIA, we have Microsoft, but we've also got the companies then that are going to help in terms of the cap equipment, right? Because we need more semiconductors. We also have Lam Research, right? And Broadcom, because they're designing chips for the cloud companies, because they don't all want to be buying off NVIDIA. That's a big risk. You've got one company coming to the table. So I would say for AI, we do believe in it, but we've got diversification of exposures, which we think is really important because there's many ways to win, but make sure you've got the companies that can win. And that's critical at the end of the day. I would say follow the earnings, the companies who have real earnings rather than expectations of earnings 5 years out from now. There's too much volatility and variability there.
Really important message within that comment and answer, isn't there? That you can't just back one winner and hope that it goes well. You've got to hedge your bets and at least have a bit of a diversification sort of within that sort of thematic. So I like the points you've made there, Fiona. I just want to turn to the macro backdrop for a minute, and you touched on this earlier with your suggestion that there wasn't a recession, an economic recession imminent. Inflation has slowed in the US. We've now got interest rates that are heading lower. Things have held up remarkably well in terms of the economy. Yeah, there's the odd soft data point here and there, but it's been pretty stable and pretty buoyant. So do you think the Fed might have achieved that elusive soft landing, or is there still some risk of recession? And how are you seeing the economic backdrop as we sort of head into 2025?
Yeah, it's a great question, right? And I think if we think about a theme for this year, besides AI, it's been interest rates and inflation, right? I've never seen a market that's moved so much by macro data, right? Particularly the assumptions of the Fed and interest rates and what's happening there. And we look for inflation to have just come below that 3%. We're not at that magic 2% that the Fed really wants, But I suppose, we're not macro strategists, right? We're bottom up stock pickers. We're looking at long-term earnings and cash flow streams. But when we think about the macro, because at the end of the day, we all have thoughts on the macro, I think when we look at it, we know interest rates are going lower. We just don't know when. So all probability right now seems to be weighing on September. But at the start of the year, the market was fixated on 4 or 5 rate cuts in the US starting in March. So are we absolutely convinced it's September? No, not until the Fed exactly tell us that they've done it, right? And they're moving lower. And then there's assumptions that maybe we get interest rate cuts, in November, we get one in December. We don't know. But I think the data supports interest rates going lower. It's very unusual, though, when you look at history, for interest rates to be moving lower, we've got double-digit earnings growth for companies. And I think this is the conundrum we're facing into right now. How much do the Fed need to do to make sure it is still a soft landing? So the base case is a soft landing. We always have worries about a recession in the US, like we do every economy. In fact, in a good year, there's always a 20 to 25% chance of recession, right? There's always a probability of recession. And I think we just have to an awareness of that. So, our base case is, the Fed cut rates, potentially September, could be later. The data seems to support it right now, but that we probably have a soft landing. Talking to companies is really important. Where they're going to spend, how they're feeling about spending. We haven't seen a gap out in the labor figures. On average, it's been similar to past trends. A little bit of hiring, a little bit of layoffs, nothing untoward there. So right now it feels like we're okay. And we'll wait to see if the data changes. And that's critical, right? You have to watch what's coming next. So for right now, it seems to be, okay so far in terms of the economy and things moving through. Just probably a little bit slower in economic growth. Inflation probably coming down a little bit. And potentially not for unemployment to gap out from here.
Interesting, but obviously important to watch some of those data releases, whether it's the labour market or consumer spending or some of those sort of other touch points that might give you a feel for where things are headed. We've talked about a few of those important themes that we've seen this year and last year. AI is one, and interest rates and inflation, as you point out, have been very dominant, but we've also got an election looming not too far away. So I realise that you are bottom-up stock pickers and less about trying to make macro predictions, or even more risky, I suppose, is trying to make political predictions. But what are you keeping an eye on in terms of potential policy changes or winners and losers? And how are you positioning the portfolio ahead of that November election?
Yeah, and I think, Mark, you're absolutely hit the nail on the head, right? We're bottom-up stock pickers. That's what we focus on. We're not really looking at top-down overview, but we also have to be cognizant of risk. We've talked about that throughout this broadcast. And so we have to be cognizant of risk that we could have within the portfolio that we're not fully aware of, right? And so I think, one, there can be volatility around elections coming into an election. As of right now, again, it looks to be a little bit towards Democrats. We're not sure what happens in the end. I think the key, though, for every investor, it's profits over politics. No matter who's in charge, the US stock market on average tends to do well, and does actually well, even better in a divided government, right? It's amazing that way. And we've had more of those than we've had clear winners. But also that it's about the economy, right? And that really drives the stock market. So profits over politics. We don't position from the top down, but there's things we have to watch for. Whoever's in power, there's things like trade, there's things like tariffs, there's things like taxes, there's things like the deficit. There's lots of work to be done, irrespective of who's in place. So, we monitor the portfolio, make sure we don't have any unintended biases within it and aware of those risks. But profits over politics at the end of the day. Still look for those earnings. If we get some volatility, maybe we've got opportunity to add to names whose fundamentals are good but have sold off because of concerns or risks within it. Healthcare is typically a sector that comes under pressure in elections because most Americans fear outliving their wealth because of healthcare costs. That can give you opportunities to add to names selectively. So for us, it's more about the opportunities the market may give us because of volatility and concerns around elections rather than positioning for a particular outcome. So I would go back to the basics: profits over politics.
Yeah, I like that. I think I'll use that, profits over politics. It's a very wise way to think, isn't it? Because it's many of us have that natural tendency to overreact or get particularly nervous when there's political change, and it matters. You've got to take note of policy movements and potential changes, but at the end of the day, for investors, it's economic growth and earnings growth, isn't it? So appreciate those comments. Look, just to finish up, Fiona, we've talked a little bit about the tech sector, obviously, and the AI stocks, and you just touched on healthcare there as a sector that typically experiences a little bit of volatility going into elections. More broadly, are there any specific industries or sectors that you particularly like at the moment? Anywhere you've got a quite an upbeat view on? And could you tell us why, and even single out any companies that fit the bill in terms of examples?
Yeah, I think, one area that the market tends to focus on a lot is the health of the US consumer. And I think we all try to read the tea leaves and find out when the consumer decides not to spend. We are a US consumption-led economy, so the consumer pays a big part. They're nearly 70% of GDP. We often joke the consumer likes to spend on things they don't need with money they don't have in the US. But there's been a lot of concerns about where they're going to be spending next. And so when we look at those opportunities, we find that there's still some good ones within the consumer space. Companies like TK Maxx, TJX, which is a discount store. So think about where you can buy your Adidas or, Nike merchandise, and also home furnishings as well. And they are having pretty good same-store sales. McDonald's is another one. Now, they're struggling right now. They're saying that lower-end consumer is definitely under pressure. That's something we're all aware of. But they're introducing a $5 menu items. Again, that'll work through and they'll get that volume back. So again, there is still good opportunities, I think, selectively within the consumer, names that have come under pressure because there's been big macro concerns on consumer spending. But I think the consumer is still good. They're just being selective on where they want to spend, right? We did that big Taylor Swift GDP push through. So now you're looking at where the consumer is going to be spending next. So there's definitely still opportunities within consumer space. And then I would say within, financials, there's opportunities selectively, not buying financials as a whole, but being very, very specific. The banks have come under pressure. There's concerns about those interest rates coming down. There's also loan loss provisions, so they're concerned about the quality deterioration in terms of credit. And so I think there's still selective opportunities. But I suppose at the end of the day, Mark, when we think about it, it's on a bottom-up stock picking basis. We're not looking at sectors and trying to find ideas. It's when we're out there talking to the companies, talking to our research analysts, where they feel those best ideas are. And so we can take advantage of it. And I think that's what it is at the end of the day. This is a portfolio. It's not about styles. It's not about sectors. It's about having the right stocks in the portfolio that can reward us over the long term.
Fantastic. That's a great way to end it, Fiona. So much appreciated. Thanks for your time. As always, very insightful. I've learned a lot in this session, and I'm sure some of our viewers and listeners and clients will have too. So once again, thanks very much for joining me, and we'll let you go and enjoy your day. Thanks again.
Thanks for having me, Mark. Anytime.
For more insights, visit craigsip.com.